Okay, I think we're going to go ahead and get started here. Welcome to the webinar. My name is Evangeline Wright, and I'm an attorney at MidPenn Legal Services. Thank you for joining us on this winter afternoon to talk about federal income tax. I am a tax attorney with MidPenn Legal Services. I handle primarily federal tax controversies, which is what we call a disagreement with the IRS. And I am here to give you some basic information about federal income tax filing to help you avoid controversies with the IRS. As I'm speaking, you will be able to submit questions, and we will take as many of those questions as we have time for at the end of the presentation. Next slide. So we're going to cover 4 basic questions with this presentation. Who should file a federal income tax return? How do you file a federal income tax return? What federal income tax credits could you claim? And what happens after you file a federal income tax return? Next slide. And as we move through, you're going to see pictures. Those are going to kind of mark the time in between each question so that you know when we're going to start a new topic. And our first topic is going to take us down a nice clear path without too many twists or turns. Next. So who should file a tax return? Some people are required by law to file a federal tax return. And the IRS gives 3 main factors. It's a combination of income, age, filing status, and then there's some additional factors. Next slide. So right here you can see the table that the IRS provides, and there's certain income floors that if you make above that floor and you have a certain filing status and a certain age, you're going to be required by law to file a tax return. In addition, some self-employed people need to file tax returns. Next slide. So if you are self-employed, regardless of your income, if you have over $400 of net earnings, so that's your profit after you subtracted your expenses, you're going to have to file a federal income tax return. You should also be aware that most rideshare and internet food delivery services report contractor income to the IRS. So many people think, I only made $1,000 doing this work. I don't need to file tax return. If you did it through Grubhub or Uber, that income is going to be reported to the IRS and they are going to be looking for a tax return from you. A lot of people use PayPal for internet transactions. PayPal is going to provide a 1099 to the IRS if you have at least 200 transactions or $20,000 worth of sales. So again, if you're self-employed, the rules are going to be a little different for you when you need to file a tax return. Next slide. Another category of people who should file an income tax return, even if they're not necessarily required to, would be anybody who suspects that they're the victim of identity theft. Filing a return puts the IRS on notice of your true income, and it prevents an identity thief from filing a fake return. So if you think there is any possibility that your personal information has been compromised, even if you are not otherwise required to file a tax return, filing the return is a really good way to protect yourself from future problems. Next slide. Another category of people who should file a federal income tax return, even if they're not legally required to, is anybody who has received or plans to claim the premium tax credit. This is a tax credit that's directed toward people who are receiving assistance in paying for health care. So if you're shopping on a healthcare marketplace, you should be filing a federal tax return. Next. And who else should file a federal income tax return? Really, and this is important, anyone who might receive an income tax refund. So even if you don't meet the minimum income that would otherwise require you to file the return, you may still be able to get money back. If you are a W-2 employee and you've had withholding from your income, there's a chance that you will get money back by filing a return. Even if you have not earned very much money, you haven't had much withheld, you may still be able to get money back for various tax credits. And we're going to talk a little bit more about that further on in the presentation. Next slide. And that is our first topic. Who should file a federal income tax return? And again, if you have questions, you can go ahead and submit those. We will get to them at the end of the presentation. The next topic we're going to take on is how do I file a federal tax return? Path is going to get a little more windy on this one, but stick with me because it's still going to be fairly clear and level. Next slide. So the best way to get assistance filing a federal tax return is if you are fortunate enough to be able to access a VITA clinic or the AARP tax aid program. VITA, which stands for Volunteer Income Tax Assistance, is a program that's funded in part by the IRS. It's staffed primarily by volunteers on a local basis, and it provides free federal tax preparation services to persons with income under $57,000 a year, to persons with disabilities, and to persons with limited English proficiency. The AARP tax aid program is administered by the AARP. The IRS also offers a tax counseling for the elderly program. And again, those are programs that provide free tax preparation services to elderly and low-income individuals. If you are fortunate enough to have one of those in your county, you want to be calling them now to set up an appointment. Most of these programs are not actually seeing people for appointments right now because the 2020 tax filing season does not start really until February 12th. But a lot of these places are already taking appointments, they're scheduling them, and they tend to book up quickly. It is also possible that even if you've been able to access one of these programs in the past, your county may not have this program available to you this season because of the pandemic. Unfortunately, there is limited availability, even more limited availability than in a typical year for these programs. If you're trying to figure out whether your county might have this type of assistance available, you can call 211, which is a hotline which will get you through to somebody fairly local to your county who can tell you about any county resources that you may be able to access, including tax prep services. Alternatively, you can go to the IRS website. Probably the easiest thing to do is just do a Google search, IRS VITA, V-I-T-A, and that will take you to the IRS website, specifically to a link you can click on and enter your zip code and find out what programs are in your area. Next slide. Another option, if you don't have access to or are not, you don't meet the requirements of a live tax preparation program, you can use IRS Free File. Through the IRS website, you can access free versions of commercial tax preparation software. In order to use a free version of the software, you have to have income of $72,000 a year or less. But the software that you access is the same software, it's commercial software that normally you would have to pay for. You should only use this option though if your tax situation is straightforward and you're confident in your ability to accurately prepare your own taxes, because you will not be working with a person to file the taxes. You will just be using software. Next slide. If you are not able to use the IRS Free File software, you can always use commercial tax software. You want to always confirm first, though, that you're not eligible to use the free software. And again, you only want to use the software if your tax situation is straightforward and you're confident that you can adequately prepare your own taxes. Next slide. The final option then is to use a professional tax preparation service. With that, you want to be careful about selecting your preparer. You want to look for somebody who's available year-round, because if some issue comes up after tax filing season, the IRS perhaps audits your account or has questions about it, you want to be able to contact your tax preparer to get additional services. You want to look for a tax preparer who has a professional credential, somebody who has to engage in continuing education, because the tax code is always changing. You want to make sure your preparer is aware of all changes. So you want to look for a CPA or an enrolled agent, or some attorneys do prepare tax returns. You want somebody who can e-file your return, because that is going to get you the quickest refund from the IRS and also is a helpful indicator that the person is a professional. You also want to always ask in advance how much your tax preparer is going to charge you. And you definitely do not want to go with a tax preparer who says they can get you a higher refund than other tax preparers. The facts are the facts. Your refund is your refund, and a tax preparer should not be able to get you a higher refund. It usually means they're doing something a little shady. Even if you don't entirely understand what your tax preparer is doing, you will be held responsible for what's on that tax return. So you want to make sure you're going with somebody that you can trust. Next slide. That is how you file a federal tax return. Our next question is going to take us through rockier territory. Path is going to be a little less clear. We are going to be looking at tax credits. Next slide. So there are several tax credits that people can claim, and this is a non-exclusive list of some of the most common. It's the Earned Income Tax Credit, Child Tax Credit, Additional Child Tax Credit, Credit for Other Dependents. Those are the ones that we're going to talk the most about. There are also two educational tax credits, the American Opportunity Credit, the Lifetime Learning Credit. Those are credits that apply for people engaging in higher education. We're not going to spend a lot of time talking about those because if you are paying for higher education, you're probably going to be aware of these credits. The Premium Tax Credit, which we talked about briefly earlier, which is the healthcare tax credit. And again, if you're receiving coverage through a healthcare marketplace, it's a tax credit you're probably going to be aware of. And then finally, the 2020 Recovery Rebate. And we are going to spend a little time talking about that. So next slide. We're actually going to start by talking about the 2020 Recovery Rebate. This is the money that most of us know as the individual stimulus money or maybe the economic impact payment. This is the money that legislators voted into existence in the spring of 2020, was sent to most people through spring and summer 2020. The first economic impact payment was $1,200 for individuals, $500 for eligible dependents, with a sliding phase out, so that if you had income above a certain amount, the amount that you received would start to reduce until it phased out altogether. In January, the IRS sent a second economic impact payment to most eligible individuals of $600 for the adult and $600 for every eligible dependent. Not everybody has received their full economic impact payment. Some people have gotten payments for themselves, but not for eligible dependents. Some people's income has changed so that they got a smaller amount, but based on their 2020 income, they should have gotten a larger amount. Some people had not filed tax returns, so the IRS did not have their information and they got no money from the IRS. In order to reconcile those amounts, people are going to need to file a 2020 tax return. This is going to include a significant portion of people who would not normally file tax returns. You do not have to have income in order to file a tax return. If you think you have not received your full economic impact payment and you think you are eligible, you need to file a 2020 tax return. And on that tax return, you are going to claim the recovery rebate, the 2020 recovery rebate credit, which is what people are now calling the stimulus money. This recovery rebate is fully refundable, which means that you should get the full amount back if you don't owe any taxes. However, if you claim this money on your 2020 tax return, the money can be offset to satisfy certain debts. This is a change. Throughout 2020, as the IRS was paying this money in advance, it could only be offset for child support debts. The IRS would only divert that money to satisfy a debt if it was a child support debt. The IRS has announced that people claiming the recovery rebate can have this money diverted to satisfy other federal debts. That's going to include income tax debts owed to the federal government, tax debts owed to the state government, still includes child support, may include student loans or some other federal debts. It is possible the IRS may think better of this, but as things stand right now, you need to be prepared for the fact that this could be offset for debts. Okay, next slide. Child tax credit, additional child tax credit, and credit for other dependents. These tax credits basically work in concert with each other. The child tax credit offers up to $2,000 per qualifying child. But the child tax credit as such is a non-refundable credit, meaning that it only operates to offset tax that you already owe. If If you are due more of the credit than, if you are due more of the credit than you owe taxes, you're not going to get that money back unless you qualify for the additional child tax credit, which is kind of an add-on program that makes part of the child tax credit refundable. Essentially, you will qualify for the additional child tax credit if your income is less than about $35,000 for the year. In order to claim the additional child tax credit, you have to have at least $2,500 of taxable earned income. That income will let you claim up to $1,400 of a refundable tax credit. So it's not the full $2,000, but you can use that money to offset a tax burden, and then you can get back up to $1,400 of that child tax credit. This year is a little different than most years. Because of the pandemic, the IRS recognizes that a lot of people have not had the same income that they've had in other years. For that reason, the IRS is letting people use either 2019 income or 2020 income to calculate this credit. So you can choose whichever income year is going to be more advantageous to you when you claim this credit. Credit for other dependents is what you're going to use if you have a dependent that does not qualify for the child tax credit. So if your dependent is over the age of 17, or if you have a dependent who's not a child, for example, an elderly parent or a non-relative, you may be able to claim the credit for other dependents. This credit is only $500 and it is a non-refundable credit. Okay, next slide. All right, and the earned income tax credit, which is my very, very favorite tax credit to talk about. The earned income tax credit is targeted to low and moderate income working parents. And the reason I love it so much is that it's one of the federal government's biggest anti-poverty programs. And again, for this year only, you can use either 2020 or 2019 income information when you file your tax return in order to get the biggest refund possible. So you're going to use whichever of those years is more advantageous to you. Next slide. So the important thing to know, though, is that a lot of people that are eligible for this credit are not receiving it. Only 4 out of 5 eligible taxpayers actually receive the earned income tax credit, which means that about 20% of eligible taxpayers are leaving money on the table, which is another reason I really, really like to talk about this tax credit, to get the word out about it. Next slide. So in order to claim this credit, basically you have to have earned income. No amount of income is too small to claim the credit. Now, the more income you have up to a certain point, the bigger the credit that you're going to receive. If you are claiming children with this credit, your credit is going to be bigger. But for a lot of people, even if you don't have children, even if you don't have a lot of income, this credit is still worth claiming. Next slide. So there's certain rules for everybody who wants to claim this credit. Taxpayers and qualifying children have to have a Social Security number that's valid for employment. So if you are the taxpayer, you got to have that Social Security number, and any qualifying children you want to claim on this credit also have to have a Social Security number. You cannot use the filing status, married filing separately. And we'll talk more about filing statuses in a minute. You have to be a US citizen or a resident alien, and you yourself as the qualifying taxpayer, you cannot be the qualifying child of another person. Next slide. There are some additional rules for taxpayers without children. You have to be between the ages of 25 to 64. This only applies to taxpayers who want to claim this credit and are not claiming a qualifying child. So if you're under the age of 25, but you have a qualifying child, you're fine to claim this credit. Same thing if you're over the age of 64. This age limitation only applies if you are not going to be claiming children on this credit. You cannot be the dependent of another person. You can't be the qualifying child of another person. And you have to have lived in the US for more than half the tax year. Rules on residency are a little different for military personnel. I'm not going to go into the details of that right now, Just know that if you're in the military, the rules might be a little bit different for you in terms of residency. Next slide. So there's some additional rules for taxpayers with children. Specifically, their child has to meet certain tests if they're going to claim the child. It's to be a relationship test, an age test, residency test, and joint return tests, and we're going to talk more about those. However, the child does not necessarily have to be your dependent for other tax credit purposes. So it would be possible to claim your child for other credits and have somebody else claim the child for earned income tax credit purposes. Very important though, the qualifying child cannot be used by more than one person to claim the earned income tax credit. So if you are separated from your child's other parent, you may need to have a discussion about who's going to claim the earned income tax credit. There are also specific rules about which parent can claim the child. Next slide. So there's some common earned income tax filing errors. And these errors are really important to be aware of because for tax year 2018, the IRS audited almost 1.5% of taxpayers who claimed this credit. And that's a fairly consistent number. I don't have specific statistic information for more recent years, but it's pretty close to that. This does not mean that those taxpayers necessarily did anything wrong or did something that caused the IRS to say, we don't think you're entitled to this credit. This just means that the IRS randomly selects this number of tax returns for people who claim this credit, which 1.5% is actually a fairly high audit rate. If you're claiming this earned income tax credit, there is a possibility you could end up being audited. And these are some of the errors that the IRS tends to catch. Claiming a child who doesn't meet the residency and relationship requirements. Married taxpayers incorrectly filing as single or head of household, or incorrectly reporting income, particularly self-employment income. If you are a W-2 employee, the IRS is going to have a record of your income, and it's pretty straightforward. If you are self-employed, the IRS is not necessarily going to have that same record of your income. Some tax preparers, some tax filers will inflate income in order to maximize the earned income tax credit. If a taxpayer gets audited, they need to be able to confirm the amount of income through business records. So it's very, very important that whatever income you claim for the earned income tax credit is accurate. Next slide. So rules for taxpayers with children. The relationship test. Child has to be your biological child, your stepchild, your adopted child, or your foster child. Or the child could be your sibling, half-sibling, or step-sibling, or it could be a descendant of any of the above. So it could be a niece, it could be a nephew, it could be a grandchild, but it has to be one of these relationships. It cannot be a more informal type of relationship where you are caring for a child who does not have one of these ties to you. Child also has to be either under the age of 19 or under the age of 24 and a full-time student. So if you remember, for the child tax credit, it has to be under the age of 17. This tax credit is a little more generous, either age 19 or under the age of 24 and a full-time student. And then finally, the residency test. This child has to have lived with the person claiming the child in the US for more than half the tax year. Next slide. Filing status. This is where things get complicated, and this is a really easy place to make a mistake. Married filing status means you are married and living together, or it could mean you are married and living apart, but not legally separated. That one's fairly straightforward. Unmarried, the way the IRS defines this is a little different than we would typically define this when people are just talking to one another. So unmarried can mean single, which we all get. Unmarried could mean legally separate, which again is fairly straightforward. This is the tricky one. Unmarried could mean that you are married, but you meet the following requirements. You file a separate tax return. You paid more than half the cost of keeping up a home for the year. Your spouse did not live in the home for the last 6 months of the tax year. Your home was the main home of your child, stepchild, or foster child for more than half the year, and you claim your child as a dependent. Next slide. So head of household filing status, which is probably the hardest filing status to understand. For this, you need to be unmarried, but it can be unmarried as the IRS defines it. It does not necessarily mean unmarried as in you are divorced or single. So remember, you could be married, but living separately and meeting all those other requirements. And for head of household purposes, you are unmarried. In addition to being unmarried, as the IRS defines it, in order to claim head of household, you also have to have paid more than half the cost of keeping up a home for the year. You have to have a qualifying person living with you in your home for more than half the year. That qualifying person must be a relative. For purposes of head of household filing status, does not have to be a dependent child, but it must be somebody related to you. Can't be roommate, can't be boyfriend or girlfriend. Has to be somebody you claim as a dependent, and that person has to have lived with you for more than half the year. Next slide. So now that we've gone through all these very, very complicated rules, I will also tell you the shortcut to doing this is to go to the IRS website and use their earned income tax calculator. If you don't want to remember this whole web address, you can just Google IRS EITC Calculator. You're going to be able to get to a program that basically lets you input information about your situation. You're going to answer a series of questions about your relationships. If you have an estimate of your income, you can input that as well. And the IRS will tell you if you are eligible to claim the earned income tax, and they will give you an estimate of how much the earned income tax credit could be worth to you, so that you know whether it's worth your time to file a tax return for that. Next slide. Okay, and that is tax credits. So you've made it through the rockiest part of this presentation. If you're still with me, give yourself a pat on the back, and let's move forward to what happens after you file your tax return. Next slide. So this is a taxpayer roadmap. I have no expectation that you're actually going to be able to read all the fine print in here. I'm showing this to you to help you understand a little bit of the complexities of what the IRS does. If you look, there are two green boxes in the upper left-hand corner. Those are the boxes where most of us stay. Most of us never actually interact with the IRS in any way other than in those green sections. So the darker green is tax filing, and the lighter green is assessment. And most of us move through tax filing on into assessment. We pay some money into the IRS, or we get some money back, and we come out at the assessment station, and we're done for the year. Some of us, however, are unfortunate enough to have to interact with the IRS in some of these other boxes. And as you can see, there's a whole lot of spaghetti going on in these other boxes. The orange box is where you're going to end up when you're being audited or when you're in exam. And if it is not easily resolved, you may move down into litigation. So you may move down to the blue box and go to tax court, or you may move down to the purple box and end up litigating with the IRS as an administrative procedure, or you may cut straight to the red box, particularly if you ignore some of the IRS notices along the way, and end up in collections, and none of us want to be there. If you are in any of the non-green categories, it is probably a good idea to seek out the help of a tax professional. Next slide. So here are some of the things that can land you in one of those non-green boxes. An identity theft notice. This is actually a fairly easy one to resolve. The IRS uses software to make sure that the tax returns that are being filed are actually above board, that there isn't fraud going on. And every year that software generates a certain amount of false positives. It flags tax returns that are actually legitimate. And if that happens to you, the IRS is going to send you a notice telling you that you need to verify your identity. This is not a big deal to do this. Usually you can do it either through the IRS website or with a phone call to the IRS. But it is very, very important that if you get that notice from the IRS, you follow through and verify your identity, because your tax return is going to be held. It will not be processed. It will not be considered filed until you've verified your identity if you get that notice. Another fairly straightforward notice you might get from the IRS is a math error notice. And that's what happens on your tax return if you add 4 and 4 and you get 9 or you get 7, which does happen to us occasionally. If the IRS notices an error that seems very straightforward and is probably clearly just somebody made a mistake and entered a wrong number, they are probably going to send you a notice saying, hey, we think you had a math error. We've corrected it to this amount. Here is the new amount that you are now supposed to get back, or the new amount that you owe. Sometimes a math error results in you getting more money. Sometimes it results in less money. Again, this is straightforward. You can either agree to it and say, yep, that was an error and you are correct, and then either pay or get the additional amount back, or you can contest it. The important thing is, though, when you get that letter from the IRS, number one, open it, and number two, follow the instructions in it, because it's probably going to be pretty straightforward to resolve. The final notice you're going to see from the IRS is a little more complicated. It's going to be an exam notice or an audit notice. This does not necessarily mean that you did anything wrong. Again, the IRS picks a certain amount of returns every year and examines them just to make sure that everything is above board. And it may be that you just got randomly selected. It is very, very important, though, that you respond to the IRS if you get this notice. Usually, you can resolve the exam fairly simply by providing some paperwork to the IRS that documents the tax status and the income that you claimed. The worst thing you can do, though, is to ignore it, because if you ignore it, the IRS is going to start adding penalties and you're going to get into a lot more trouble. You will never go to jail. The only people who go to jail are people who commit big fraud in a very purposeful way. You see celebrities going to jail, but normal people almost never do it. But you do need to respond to an audit in order to avoid owing more money. It's a really good time to reach out to a tax professional and just get a little help. Next slide. Okay, refunds, which is the happy part, what we all want to know about. By law, the IRS cannot issue refunds for people claiming the Earned Income Tax Credit or Additional Child Tax Credit before mid-February. Those refunds always come a little more slowly. This year, the IRS actually isn't processing tax returns until I believe February 12th. The IRS expects that best case scenario, people claiming the Earned Income Tax Credit or Additional Child Tax Credit will see their refund the first week of March 2021. And that is only if you have chosen direct deposit and there are no other issues with your tax return. So tax refunds perhaps coming a little slower this year. Next slide. The other thing to know about a refund, be very, very cautious about tax advance refund offers. If you are going with a commercial tax preparer, a lot of them offer an advance on your tax refund. Read the fine print. If they say they're not going to charge you for this, it is probably because they have inflated their tax preparation fees and you're paying for it upfront with your preparation fee. Or they may be giving it to you as a debit card that charges high fees. There may be an interest rate involved. If you're going to accept one of these offers, be very, very careful that you understand exactly what you are accepting. Next slide. If you want to check on the status of your refund, you can always go to the IRS website to get my refund, enter a little bit of personal information to identify yourself, and find out if your tax return has been processed and when your refund is projected to get to you. Next slide. And that is it. You've made it all the way through. If you're awake, give yourself a little cheer. You've got a rainbow to enjoy here. If you have any questions, now would be an excellent time to ask those questions. Do we have any questions?
Okay, I'm not seeing any questions.
All right. Excellent. You guys are great listeners. I'm going to assume you all made it through with me then, and this all made complete sense to you. If you do have questions, you can always go to the IRS website.
We have a question.
All right.
An individual wants to know, what about unemployment?
Unemployment is taxable. You are going to have to report that on your income tax return and pay taxes on it. Any other questions?
Another individual wants to know what I can do to reduce my taxable income.
We all want to know that, don't we? Nobody likes paying taxes. So that is a question that is very, very specific to your individual situation. And probably you would be best off consulting a tax professional who has access to all of your tax records and is aware of your specific situation. It isn't a question that I can answer generally because everybody's situation is so unique to them. Any other questions?
Here's another one. Can you go over the category of married filing separate? I'm not very clear about it.
Okay, so basically married filing separately is where you are married and you do not want to file a tax return with your spouse for whatever reason, and you cannot claim any of the other tax statuses. You are only going to use the tax status married filing separately if you can't find a way to use one of the other tax statuses, because this is the least advantageous filing status. If you can qualify for one of the other categories, you want to use that category.
Okay, here's another question. Is unemployment taxable at the state and local level or just federal level?
It's a good question. I primarily do federal taxes. I would assume that it is probably taxable at the state level. When you are going through your tax preparation, the form that you are using, particularly if you're using software or a tax professional, is going to be able to give you that information. Any other questions?
Someone wants to know, where can I see the recording of the presentation? We'll be posting that on MidPenn's YouTube site. We have a YouTube channel, and it will be up on our Facebook page.
All right. I'm going to have you move to the last slide then, Linda.
Oh, we have another question that just came in. I heard this year that they are advising that you do not file through paper.
Yeah, and actually, that's an excellent question to ask, and I'm really glad you asked that. If at all possible this year, you need to e-file. The IRS is extremely behind in processing mail. Tax returns that were filed through the mail over summer 2020 have still not been processed yet. I can think of actually several clients who are still waiting on having a tax return processed. If you want your tax return processed anytime soon, you have got to e-file it. There's no guarantee that the IRS will get to it for months if you paper file it. Some people are going to be unable to e-file. There are certain situations where people are going to have to paper file. And if you are unfortunate enough to be in that category, you need to assume that it could take several months for your return to be processed. All right. Any other questions?
There don't appear to be any other questions.
All right. Well, I want to thank you all for joining me this afternoon. I very much appreciate you spending the time with me. And you are free to sign off.